In this video, we will look at accounting for income taxes. That includes an asset revaluation, tax loss, and a change in the tax rate. For our purpose, this company's trial balance before entering the required adjustments for the year ending 30th June 2021 is provided to us, and the corporate income tax rate is 30%. The trial balance shows the income statement items: revenue, cost of sales, and the gross profit format, and two expenses: depreciation and other expenses, then the profit before tax, income tax expense, and a consequent profit after tax. Then using the profit after tax, adding on to the prior year retained profits, share capital, revaluation surplus, that is shareholders' equity. Additionally, we are given long-term liabilities, deferred tax liability, income tax payable, that shows other short-term liabilities, that shows the liabilities, and together with shareholders' equity and liability, we have 6 million. Then we are given the asset side comprising non-current assets, land, motor vehicle and its associated accumulated depreciation, fixed deferred tax asset, and the total of non-current assets. Then the current assets: inventory, receivables associated with doubtful debts, and together with the non-current assets, the total assets are 6 million. So the debit of total assets, 6 million, equals credit of shareholders' equity and liability, 6 million. The following adjustments are required to the trial balance, and we are given 5 adjustments. During the year, land was revalued by 50,000. The second item is company has carried forward a tax loss of 100,000 and intends to use it to reduce the tax burden in the current year. The tax base of the motor vehicles at the end of the year is given to us 168,750, and they're depreciated on a straight line basis with no residual value expected. Number 4, company has not recorded the tax effect of accounting entry relating to accounts receivable balance. And the 5th is inventory value shown on the balance sheet or the trial balance is net realizable value, but the inventory cost was 100,000 more than that. So there are 2 parts. Part A required prepare the journal entries to complete the trial balance as of 30th June 2021. So the first is land revaluation. So we increase the land by 50,000, and the tax effect of that at 30% is 15,000 deferred tax liability, and the remainder is revaluation surplus. A more detail of this is we have the 50,000 land we debit and we credit revaluation surplus 50,000. And we have the deferred tax liability of 15,000, and we debit income tax expense of other comprehensive income 15,000. And at the end of the year, we credit that other comprehensive income 15,000, and we transfer that as a debit to revaluation surplus. Therefore, revaluation surplus becomes 35,000. Our second adjustment entry relates to the tax loss carried forward 100,000. It's been now used, so the using of that decreases the tax payable. We debit tax payable 100,000, and we credit deferred tax asset 100,000. Our third entry is the tax base of motor vehicles. At the end of the year, the tax base is 168,750, and our carrying value of the motor vehicle with trial balance information is cost is 250,000. There was accumulated depreciation of 50,000, and therefore the carrying value becomes 200,000. And the tax base is 168,000. So the carrying value is higher than the tax base. So there's a taxable difference between the two, taxable difference, and applying the tax rate, there's deferred tax liability, we credit 9375, and we debit income tax expense 9375. Our fourth is the company has not recorded the tax effect of the accounting entry of accounts receivable. Our accounts receivable carrying amount is 500,000 is the gross amount, and there was doubtful debts of 200,000. Our carrying amount therefore is 300,000. But the tax base is its cost 500,000. Carrying amount is less than the tax base by 200,000. So this is a deductible difference. Applying the tax rate gives us the deferred tax asset. We debit deferred tax asset 60,000, and we credit income tax expense 60,000. Our fifth entry is where the inventory value is shown at net realizable value on the trial balance, but the cost is 100,000. It's more. So the difference for tax purposes, the value is tax base is 1.1 million because our net realizable value is 1 million. So cost base is more 1.1 million, and that is the tax base. So it's an asset, and the difference is where the fair value is less. So this is a deductible difference. Applying the tax rate gives us the deferred tax asset. So we debit deferred tax asset and credit income tax expense. Now that we have got all the journal entries, we can now include them in adjustment columns as debits and credits, and then have a notes column to show our interest correspondingly. Our first entry was on the revaluation surplus. Our land we increased by 50,000. Our deferred tax liability increased by 15,000, 30% of 50,000, and the remaining amount was revaluation surplus 35,000. The second item that we had was carry forward tax loss. Now we're going to write off the tax loss. When we write off the tax loss, we are now debiting the tax payable because the tax payable is going to decrease, and that is coming out of our deferred tax account. So our deferred tax asset account is decreased by 100,000. So that's our second entry. Our third entry relates to the motor vehicles, in that there is income tax expense and deferred tax liability 9375. Our deferred tax liability increases by 9375. So our deferred tax liability increases by 9375, and our income tax expense increases by 9375. We credit deferred tax liability and debit income tax expense. Our fourth entry relates to the tax effect, as not recorded tax effect of accounts receivable, and on that deferred tax asset increases by 60,000. Our deferred tax asset increases by 60,000, and income tax expense decreases by 60,000. So our income tax expense decreased by 60,000. Our fifth entry relates to the inventory value. The journal entry is to increase deferred tax asset by 30,000. So deferred tax asset we increase by 30,000, yes, that, and we then decrease the income tax expense by 30,000. So once we have done this adjustments entry, we can look at with our total adjustment debits are equal to total adjustment credits. And once we have ascertained that, then we can add them across, taking care of the debit and credit items, and knowing which item that we are adding, whether it's a credit balance or a debit balance. And then we can come up with the adjusted trial balance. The differences occur in income tax expense because there are adjustments. Then differences occur in the revaluation surplus and deferred tax liability. And on land, deferred tax asset is where the differences occur. Part B of this question has additional information. It says, after the company prepared the trial balance, the government announced the corporate tax rate for the year ending 30th June 20x1 had been revised from 30% to 25%. So the question asks, part B, prepare the final trial balance after considering the revised tax rate. There are three tax balances that can affect from a tax rate: income tax payable, deferred tax asset, and deferred tax liability. If we look at income tax payable in our adjusted trial balance, we see that income tax payable in that is 0. So it is 0. So therefore, there's no adjustment required for that. No adjustment required for that. Then the deferred tax asset and the deferred tax liability from the adjusted trial balance is 990,000 is deferred tax asset balance, and deferred tax liability is 524,375. So if you look at our balances, 990,000 and 524,375 for deferred tax asset and deferred tax liability correspondingly are from the adjusted trial balance. Now they are stated at 30% tax rate. So we now gross it up to find the taxable balances and the deductible balances. So we divide this by 30%, which is the tax rate that was applied to bring it to the asset and liability balances. And then we get the deferred tax asset, 3.3 million. And the difference, and then we apply that new tax rate, the revised tax rate at 25%, and it becomes 825,000. So the deferred tax asset should be stated at 825,000, which means it requires a reduction or a credit of 165,000. So we write a journal entry. We show deferred tax asset credit 165,000. Deferred tax liability, the taxable difference is 1747917. Now we apply the new tax rate, 25%, and now with the balance, revised balance, we can see the deferred tax liability also should be decreased by 87,396 by debiting that account. So we debit deferred tax liability 87,396. So the difference between these two go into the income tax expense, and that's 77,604. Otherwise, we also can do individually deferred tax liability 165,000 and then 165,000 we debit income tax expense, and deferred tax liability we say 87,396. 396 we credit 87,396, and when we take the net of that of the income tax expense, that equals to 77,604. So this is our adjustment 6 we are going to do. To get the final trial balance, we start with the adjusted trial balance. We now enter under the adjustment columns debit and credit our journal entry, that's income tax expense 77,604 and deferred tax liability 87,396, and that's a debit balance, and deferred tax asset is 165,396. And once we have included these balances, we can add them up. And once we have added them up, we can see the shareholders' equity and liability. Total credits equal 5,875,000, and our assets, total assets equal 5,875,000. So our total debits and credits now match. And that's the final trial balance. That brings us to the end of the video, and thanks for watching.